In 2012, India started off with expectations being on the lower side for the economy and for the markets. But as the year progressed, the market has actually surpassed most people's expectations, particularly towards the last quarter of the year. Whereas this was not entirely unexpected, the quantum of increase in recent months has surprised many. The valuations were very reasonable to start with, and during the year, expectations of the economy bottoming out and earnings cycle bottoming out, as well as hopes on reforms accelerating, helped the market move higher towards the year end. When it comes to the economy, however, economy has been bouncing off the bottom and chugging along with subpar growth rates, whereas some of the forward indicators are flashing amber. It's too early to make an inference on data that is coming in. Data is yet to stabilize. We are exiting the year with growth still being subpar for India. When it comes to the outlook for India in 2013, some of the forward indicators on the economy, such as interest rates as well as outlook for inflation, look encouraging. They all point to a steady recovery on the economic front, if not a spectacular recovery. In 2012, earnings expectations were low and they were more or less met, and in 2013, there is a good possibility that the earnings expectations, which start off on the lower end, surprise on the positive side. The biggest change to the outlook for 2013 that has emerged over the last few months is on the governance front and on the policy front. The political priority for growth has moved up several notches. For the first time in about 3 years, the ruling Congress coalition in New Delhi has given high priority to growth, and this is expected to continue into 2013. When it comes to the risks in the economy and for the markets, execution from the government will be a key thing to watch out for. Fiscal deficit still runs high, and the ability of the government to contain fiscal deficit will be very keenly watched by the market as we go into 2013. In 2012, DNB India had a pretty good year so far, with the fund outperforming the benchmark index in what has essentially been a volatile and somewhat challenging year. Going into 2013, there are 3 core elements of our strategy for the fund. Number 1, stay with the winners. Number 2, stay with quality. And number 3, stay focused on the side of growth. Staying with the winners, if a company has done well in rather challenging circumstances over the last couple of years, that company is likely to benefit a lot when a recovery sets in, and therefore staying with winners is essentially a very sensible strategy in these times. Staying with quality is equally important, because we are still not out of the woods either from a global perspective or from the perspective of India, and quality works. Finally, erring on the side of growth is also important as we expect the economy to start recovering gradually going into 2013. Therefore, we have positioned the portfolio towards growth stocks, moving several notches up in composition. The DNB Asian Small Cap Fund has had fairly steady year, particularly improvement seen towards the second half of the year. It's been facilitated in no small measure by the good contribution from India in 2012. Going into 2013, Chinese valuations look attractive, and after 2 years plus of poor performance from the Chinese markets, perhaps it is time for China to start delivering. We are evenly placed between India and China, with the allocation being little under half in both the markets, and we are positioning ourselves for a potential recovery in China into 2013.
"2014 is a cheerful year for China. We are seeing green shoots in macroeconomic data to show signs of recovery. The 18th CPC National Congress in mid-November confirmed membership for new government, a government that led by Xi Jinping and Li Keqiang. More importantly, it sets the goal of doubling 2010 GDP and GDP per capita by 2020. All these forces work well to put China back to a growth mode. The key emphasis of new Chinese government is to trade for balance and quality growth in China. They will speed up the urbanization in China. By doubling GDP per capita in 2020 means doubling the Chinese consumer spending power. Our China portfolio is always positioning in the theme of urbanization and Chinese consumption, so we are in a sweet spot to benefit from this backdrop.